December 2025. Foreclosure filings just hit 44 over 990 properties in a single month. That's up 57% from last year, up 26% from just last month. 1 in every 3,163 American homes now has a foreclosure filing against it. But here's what they're not telling you on the news. This isn't random. This isn't just people who can't pay their bills. What's happening right now is the direct result of 3 invisible forces that have been building for years. Forces that are about to converge in 2026 in a way that will wipe out the equity of millions of homeowners who think they're safe. If you own a home, if you're thinking about buying one, the next 7 minutes will show you exactly what's coming and why most people won't see it until it's too late. Let me show you something that Wall Street doesn't want you to understand. Your mortgage payment is not your housing cost. Your mortgage is just the beginning. Right now, the average American homeowner is spending nearly $16,000 every single year beyond their mortgage payment. $16,000. That's $1,300 a month on top of your principal and interest. And that number just increased 4.7% in the last year alone. Your income? That went up 3.8%. The math doesn't work. Let's break down where this money is going. Homeowners insurance has exploded 52% higher than it was in 2020. In Miami, insurance premiums now average $4,600 per year. That's up 72% in 5 years. In New Orleans, Sacramento, Atlanta, insurance costs are up between 56% and 72%. These aren't small cities. These are major American metros where millions of people live. Property taxes have surged 27% since 2019. In New Jersey, homeowners are paying over $9,400 a year just in property taxes. That's over 2% of their home's value gone every single year. In Florida, 3 of the 5 metropolitan areas with the biggest property tax increases in the country are right there. But here's the critical part that nobody's explaining. When you have a mortgage, these costs don't stay separate. They go into your escrow account. Your lender collects them every month as part of your payment. And when insurance goes up $200 a month, when property taxes jump $150 a month, your total monthly payment increases even though you have a fixed rate mortgage. The typical homeowner now dedicates about 1/3 of their monthly payment to taxes and insurance. For people who bought recently with tight budgets, that extra $300, $400, $500 a month is the difference between making it and missing payments. And once you start missing payments, the clock starts ticking. 3 months behind, you get a default notice. That's when you officially enter foreclosure proceedings. Lenders initiated foreclosure proceedings on 28,269 U.S. properties in December 2025 alone, up 46% from a year earlier. Now, let's talk about the second force. And this one is mathematical. This one is guaranteed. Between 2020 and 2022, over 1.7 million Americans took out adjustable rate mortgages. Why? Because rates were low and ARMs offered even lower introductory rates. A typical 5-year ARM in 2020 might have given you a rate of 2.5% or 3%. Your payment was affordable. Everything seemed fine. But here's how these loans work. After that initial fixed period, usually 5 or 7 years, the rate adjusts based on current market conditions. And when it adjusts, it doesn't just go up a little. If your monthly payment was $1,200 under the initial rate, it might jump to $1,700 or more after the reset. Do the math with me. 2020 plus 5 years equals 2025. 2021 plus 5 years equals 2026. Right now, hundreds of thousands of these loans are hitting their reset dates. The fixed period is already reset for 328,000 homeowners, and 102,000 more loans will reset over the next 12 months. When your ARM resets in today's environment, your new rate could be 6%, 7%, even 8%, depending on your loan terms. That's a payment increase of 30%, 40%, sometimes 50%. If you were paying $2,500 a month, you're now paying $3,700. Where does that extra $1,200 come from every month? For most people, it doesn't. Roughly 94% of mortgage defaults occur after a homeowner loses income due to unexpected circumstances. But when your payment jumps $1,000 overnight, because of an ARM reset, you don't need to lose your job. The reset itself creates the crisis. And here's what makes this truly dangerous. Many of these ARM borrowers are already feeling pressure from the hidden cost explosion we just talked about. Their insurance went up, their property taxes went up, and now their mortgage rate is about to reset higher. It's a triple hit. Income stays flat. 3 major housing costs all spike simultaneously. This is what financial planners call payment shock, and payment shock leads directly to default. The data proves it. States with high ARM concentrations are already showing stress. In September 2025, foreclosure filings jumped 20% compared to a year earlier, with much of that increase concentrated in areas where ARM resets are happening. Now we get to the third force, the one that's going to determine who survives this and who doesn't. Equity, or more specifically, the complete disappearance of it. For years, rising home prices created a safety net. Even if you got into trouble, you could sell. Even if you needed to refinance, you had equity to work with. That safety net is disappearing fast. In the third quarter of 2025, only 46.1% of mortgaged homes were equity rich, down from 48.3% a year earlier. That might not sound dramatic until you flip the perspective. Over half of American homeowners with mortgages do not have enough equity to be considered financially secure. Meanwhile, underwater mortgages are rising. The share of underwater mortgages increased from 1.0% in April 2025 to 1.6% by October. Still low by historical standards, but the trend is accelerating. And it's concentrated in specific areas: Florida, Texas, Colorado, Arizona. These are the states where home prices exploded during the pandemic and are now correcting. Florida's equity-rich share dropped from 52.5% to 46% in just 1 year. In places like Cape Coral, Lakeland, Tampa, Austin, Dallas, San Antonio, people who bought at the peak in 2022 are already underwater or dangerously close. Why does this matter? Because equity is your escape hatch. When you have equity, you have options. You can refinance to a lower payment. You can sell and move somewhere cheaper. You can take out a home equity line to cover emergency expenses. When you don't have equity, you're trapped. Refinancing options are limited when you're underwater, as lenders typically require a minimum amount of equity in the property. If you need to sell, you have to bring cash to closing to cover the difference between what you owe and what the house is worth. And here's the brutal reality. The people most at risk right now are the ones who bought in the last 3 years with low down payments, FHA loans, VA loans, these programs that helped people become homeowners with just 3% or 5% down. These borrowers start with thinner equity cushions, and when home prices slip even modestly, they can move underwater more quickly than conventional borrowers. Now combine all three forces. Your insurance goes up $200 a month, your property taxes increase $150 a month. Your ARM resets and adds another $800 a month to your payment. That's an extra $1,150 a month you didn't budget for, and you have no equity to refinance, no equity to sell and escape. You're locked in with a payment you can't afford and no way out. What do you think happens next? This is why the foreclosure data from December 2025 matters so much. Lenders started the foreclosure process on 289,441 properties. In 2025, up 14% from 2024. That's just the beginning. Those are the people who are already in trouble. The ARM resets are still coming. The insurance increases are still hitting. The property tax reassessments are still landing. Foreclosure starts increased 19% from November and 46% year over year in December. This is acceleration. This is momentum. This is a trend that's building, not slowing down, and the geography tells you everything. States with the worst foreclosure rates are New Jersey, South Carolina, Maryland, Delaware, and Florida. What do these states have in common? High property taxes, soaring insurance costs, and significant ARM reset exposure. Financial analysts keep saying the market is fine because overall foreclosure rates are still below pre-pandemic levels. They're looking at the wrong data. They're comparing today to 2019 when millions of people had forbearance protection, when rates were at historic lows, when insurance was half what it costs now. The correct comparison is trend direction, and the trend is clear, up, accelerating, broadening beyond just a few markets into different regions across the country, suggesting that rising foreclosure activity reflects broader affordability pressures affecting homeowners nationwide. So what does this mean for you? If you own a home with an ARM that hasn't reset yet, you need to plan now. Don't wait until 3 months before the reset date. Look at refinancing options today while you still have equity and income to qualify. Talk to multiple lenders. Understand what your payment will become. If you're carrying an adjustable rate mortgage and your insurance or property taxes have increased significantly, you need to stress test your budget. Can you afford another $500, $800, and $1,000 a month when that reset happens? If the answer is no, you need to act now. If you bought in the last 2 years with a low down payment in markets like Florida, Texas, Arizona, Colorado, you need to understand your equity position. Get your home appraised. Know exactly where you stand. Because if you're close to underwater, you need to build a cash reserve for the inevitable expenses coming. The people who lose everything in situations like this aren't the ones who saw it coming and couldn't avoid it. They're the ones who didn't see it at all until the foreclosure notice arrived. 44,990 foreclosure filings in December. That number is going higher in 2026. Make sure you're not one of them.